a remarkable malfunction has suddenly occurred, rekindling one of the most contentious and enigmatic debates in the XRP community. Users reported that XRP briefly flashed a price of $43,000 per token on Crypto.com. Yes, you heard correctly, $43,000. The impossible appeared to be real for a brief while. And what many thought was a technical glitch might be the most significant hint yet about what banks and organizations really observe behind the scenes. Nor was this the only instance. Similar issues have surfaced over time on Coinbase, Binance, and even smaller exchanges, displaying XRP prices ranging from $7,000 to $22,000 and higher. The incident is always dismissed as a display glitch or an API issue, but what if these irregularities aren't just arbitrary errors? What if there is, in fact, a distinct price hidden deep inside the institutional systems, the one that banks and liquidity providers utilize for internal settlement? We're going to examine every aspect of that hypothesis today, which is gaining traction like wildfire. Let's start with the actual Crypto.com issue. Within minutes, videos and screenshots of live XRP balances soaring as the advertised price jumped beyond $43,000 per coin were making the rounds on social media. Although the surge was only apparent for a brief period of time, it was sufficient to cause widespread confusion and provide some support for the long-held notion that XRP has a hidden institutional valuation that is far higher than its retail market pricing. In a swift statement, Crypto.com blamed a data feed breakdown for the display error. This is where things start to get interesting, though. At the time, no other assets were impacted by the bug. Solana, Ethereum, and Bitcoin all kept showing their typical values. XRP was the only one to spike. That brings up a basic query. Why would a single asset be impacted by an isolated data error? And why would it always be the same asset? We must examine the larger context of XRP's distinct function in the financial ecosystem in order to comprehend why this incident struck such a deep chord. XRP was never intended to be only a speculative investment, in contrast to other cryptocurrencies. Its architecture was specifically designed to act as a bridge for liquidity in cross-border transactions. Through Ripple's on-demand liquidity infrastructure, banks and payment providers can immediately transfer value between currencies and jurisdictions. Retail market factors alone do not determine the price of XRP in that closed institutional context. Its usefulness and capacity to instantly represent and transfer enormous amounts of money make it valuable. The concept of a distinct high-value internal pricing mechanism doesn't seem that crazy if you begin to think about XRP in those terms. Let's discuss the idea of pricing in institutional ledgers. Large-scale settlement systems frequently function on separate valuation levels than retail markets in the banking industry. For instance, there may be minor to major differences between the foreign currency rates utilized in interbank transfers and the retail exchange rates available to the general public. Instead of engaging in speculative trading, the institutional world deals in notional values. Therefore, when members of the XRP community conjecture about a hidden bank pricing, they are effectively implying that there is a private ledger, possibly connected to RippleNet, where the price of XRP's liquidity is determined by the value at which it settles rather than by its market capitalization. In theory, XRP's institutional valuation could be far higher than its current retail price, if it were possible for a single coin to move the equivalent of $1 million worth of liquidity in a matter of seconds. Let's return to the glitches. At least half a dozen similar oddities using XRP have occurred in recent years. Coinbase briefly listed XRP at $7,200 in 2021. A year later, it was valued at $12,000 in another exchange. Brief price spikes into five figures were recorded by smaller trading platforms in Asia and Europe, but they quickly corrected. Exchanges consistently blamed display issues or API feed problems. However, there appears to be a strange pattern to these mistakes. The glitched prices are frequently round values, and they only ever involve XRP. 12,000, 22,000, 43,000, and 7,000. Not fractional, not random, but neat, uniform numbers that almost seem intentional. It would be quite unlikely for them to regularly produce these particular outputs if these were genuinely random data input problems. The design of Ripple's on-demand liquidity corridors offers one explanation. Bank-to-bank XRP transactions frequently happen at machine speed, thanks to algorithmic liquidity pools that convert cash to XRP in milliseconds. These pools frequently function off-chain, calculating fair value using internal pricing engines that take counterparty risk, slippage tolerance, and liquidity availability into account. If data is periodically leaked to public APIs by those internal systems, then for a few moments, the teacher, the stencher, and the diver stand. Sir, it might help to understand why some exchanges exhibit astronomical XRP valuations for a brief period of time. Retail is not the intended use for these internal prices. Banks employ them to balance liquidity and transfer notional value. The concept of pre-valuation is an additional viewpoint to take into account. Based on the overall liquidity needs for the global settlement system, some observers think that Ripple's network has already assigned XRP a theoretical future value for institutional purposes in collaboration with specific central banks and liquidity providers. If XRP were to meet even a small portion of that liquidity requirement, it would be connected to the 1.2 quadrillion derivatives market and the trillions in daily cross-border transactions. For it to be a successful global bridge asset, its price would have to be orders of magnitude greater than it is now. A bug that briefly displays the institutional pricing before the system corrects could be readily caused by a few leaks from systems set up for that valuation. Naturally, skeptics have counter-arguments. They maintain that price oracles sometimes take inaccurate data from test environments or, improperly designed API answers, and that these errors are just database mismatches. That is a technical explanation that is entirely legitimate. Even still, it is still unclear why exchanges would initially test XRP data at such outrageous numbers. In test systems, if XRP's theoretical settlement range actually extends into the tens of thousands, then there's a reason why engineers and developers are modeling such valuations. Real-world circumstances serve as the basis for system tests. It indicates that XRP's utility potential, rather than its speculative price, has previously been modeled at that scale if its internal test environments replicate high-value liquidity transfers. It's also impossible to overlook how consistent insider stories have become. Although they are usually careful with their language, Ripple officials have made several references to XRP's capacity to manage global liquidity. According to Brad Garlinghouse, XRP only needs to serve as a bridge between all other global currencies in order to achieve such high prices. The infrastructure is already in place, as seen by Ripple's collaborations with significant financial institutions such as SBI Holdings, Santander, and central banks. Therefore, it almost seems significant when a website like Crypto.com inadvertently displays XRP at $43,000, as if there were a fault in the matrix that exposed what was going on underneath the surface. Let's examine the maths in more detail. $500 billion in daily settlement value would be generated if XRP were to facilitate just 10% of the $5 trillion daily global foreign currency volume. Given that there are over 50 billion XRP in circulation, the token would have to manage daily liquidity flows of $10,000 per coin. With the exception of derivatives, tokenized real estate, and international loan instruments, that represents only 10% of the FX market. Now, XRP's necessary notional price might easily rise into the five figures if it were to act as the bridge for a larger segment of global liquidity, like the 1.2 quadrillion futures market. Given those figures, the $43,000 mistake doesn't seem so implausible. Clarity of regulations is another important consideration. Institutional integration is becoming a reality as a result of Ripple's continuous license acquisition success. It appears that XRP's use will soon extend beyond corporate settlements to sovereign-level applications, as seen by Ripple's foray into central bank digital currency initiatives. Central banks will require liquidity assets with steady, scalable value if they start using Ripple's technology for cross-border settlement. The enormous price potential of XRP becomes crucial in this situation. For this reason, some people think that organizations are already testing or modeling XRP at prices that are significantly higher than those of the retail market. Is the